little I put into the entry. And what happens is I have so little attachment to these trades that it's very, very simple and easy to follow my system. So that was really the lesson I wanted to talk about with this PIO, is that when we put all this effort into our trading and it doesn't go our way, it's very, very difficult to let it go because of all of that effort and all that stress that you've put into the position. That is one of the things that make people hold on to losers. This experiment, it's so easy. When you pick things at random on a Ouija board because you saw a lot of water, it's so easy to dump a trade and follow your system. Just another example to show how we are the problem in our trading. Not the markets, it's we are the problem. And it's the reason why Patrick and I put this podcast together, is to try to get people to, first of all, understand how we are the problem, then to understand, to look inside of you and say, oh, what are my issues? And then third, how to fix those issues so you don't undermine yourself. All right, let's keep going on with numbers because I got a lot of numbers to get through. All right, so we talked about our biggest gain, our biggest loss. Now let's think about this. We had a $100,000 account. At one point it was down to like 96,000, I think was our low point. And at our high point, we ended just off of our high point. Our high point was like 116,000. So if we're doing 1% position size, that's going to be about $1,000 loss at 2x ATR. So again, that's what we said. At 2x ATR, we want $1,000 monetary loss, 1%. Our biggest loss was on EWG. It was a German ETF. I was traveling in Germany, so we did a German ETF. We were short, and we lost $1,415. Patrick, do you have any idea how we lost more than 1,000, even with the trailing stop?
Ooh, good question. I'm sure it's kind of obvious as soon as you say it, but go ahead and say it. I don't know.
Well, you deal in the world of currency so much that this was a stock. And this was not just a stock, but this was an international stock. So pretty much all of these stocks traded over in Germany, but I bought the ETF that traded in America. So basically, by the time the American market opened up, the German market was just about to close down. So whatever those stocks did in Germany would already be adjusted to what happened in the ETF in America. So there was a big up day in Germany. And then when the EWG opened up, it opened up gapping above our stop, causing us to lose more than the $1,000. One of the great things about Forex, one of the things I love about Forex, is the lack of gaps. It's really, really nice, but in the world of stock trading, gaps are an issue, and you theoretically can, and I will guarantee you, on 100 trades, you'll have at least one, if not two or three, that are going to have a larger loss than that 1% that you expected.
Okay, well that makes sense. I don't feel so bad about not knowing. Yeah, my mind wasn't in that scope, but that's really interesting too. So, well, I guess just goes to show too that on the downside, just to add on to why I think that the stats here are so spectacular, that even some of the losses could have gone past 2 times ATR, and this system still ended up doing what it was doing. So by all means, keep going.
That is exactly the takeaway, is that, look, things happen that are outside of our control in trading. There's going to be gaps. There's going to be big moves. Even in the Forex market, there's going to be big moves where your stops get slipped. That stuff happens. You can't fall apart over it because it happened. You have to trust that over 100 trades, that you will be able to make up that deficit by staying consistent. The problem is, in those real world situations, when someone takes a much bigger loss than they expected to, this is where they screw up, where they either position size too large, or they try to get it back, or they get desperate and they start making trades they wouldn't have. These are those moments. So this moment right here, if this was you and you were trading and all of a sudden you expected there to be this loss and it was bigger than expected, these are the moments that challenge you as a trader, that are going to want you to like bail, say, oh, I need to do something else to make sure this doesn't happen. And then we talked about this in a previous podcast about jumping systems. You can't jump systems. This is the time where people jump systems all the time and they say, oh, my system doesn't work. Trust in the system. These things will happen in trading. I guarantee you that there are going to be things that happen you didn't expect, or you take losses that are bigger than you expected to take. You need to keep swinging and stay diligent and consistent. Do not jump systems at those moments.
Well, I think that's a really good segue into your next section, if I'm reading this right, and that is when you just so happen to have your biggest win and your biggest loss of this entire 100 trade series.
We've had several episodes on dealing with slumps, dealing with streaks, what to do when you're hot, what to do when you're cold. A lot of our episodes have been based on this. I highly recommend everyone go to the Flat Earth Trading Society public journal. And if you go to that public journal, you can see all 100 trades. And Patrick, I'll give you the link that you can put in the YouTube description below, or you could go to the Flat Earth Trading Society channel on YouTube. It's on every single video there, the public link. You can go through and see how streaky it was. At one point, there was an 11 consecutive loss streak from December 29th to January 24th. This is using random methods, and it created an 11 consecutive loss streak. What do you think a normal trader would be thinking about after 11 consecutive losses?
It's a word that I'm not supposed to say on YouTube because I can get demonetized, but leaving this mortal coil maybe would be a better way to say it.
This happened. This is real trading. This will happen to you. At some point, you are going to have 11 consecutive losses. Now, in this system, again, I didn't care. I knew that it was going to, well, I didn't know, but I was confident that it was going to make money over 100 trades. I was risking my 1%. And you know what? It wasn't that big of a deal. Here's what I did. I kept swinging. But what we really learned here, there were some things to learn here. Let's think about what happened from December 29th to January 24th. Now, Patrick, we meet at the first of every single year with all of our traders, and we do this every single year because there is something in the stock market called the January effect. For 11 months out of the year, trend trading works very well, and all the numbers back it up. All the numbers back it up to where if you were to buy the top 10% of the stocks in the stock market and hold them for that month, 11 months out of the year, you would outperform the average and the lowest 10% of stocks. During those months, 11 months out of the year, they underperform the stock market average. There's 1 month out of the year where that doesn't happen. That's in January. There's huge sector rotation going on. There's portfolio rebalancing where people say, hey, my tech stocks have gotten too large a part of my portfolio. I need to sell those stocks and reinvest them into the parts that have gotten too small. Now, why did they get too small? Because they underperformed. So this right here is just a great example. We already talk to our traders about it every January, say, hey, this is likely what's going to happen. Don't get hit by it. Don't get hit by the sector rotation. Now, we couldn't do that in this example or in this experiment because remember, it's just a machine. It's random. So there's things that we can learn through all of these things. Also, during that period of time, it ended up being a more volatile period than the prior period. That is really bad for systems that have stop loss orders. Think about it. You have a system where you put in a trade, you have a stop loss. If volatility spikes, the odds that your stop is going to get hit become much higher than they were when you put that stop in place. So when you're using ATR, and let's say the ATR has gone down and down and down because volatility has gotten lower and lower and lower, when you put trades on with low ATRs and ATR goes up substantially, your odds of getting stopped out on trades jumps to maybe 50%, 70%, 80%. It wasn't because you made a bad trade, it's because we went from low volatility to high volatility. I love ATR. Patrick, I know you love ATR. It's a fantastic thing, but this is one of the negatives of using ATR is when you have a very low volatile period and you adjust your stops based on those ATRs. When volatility spikes, you're going to get losses during that period of time.
Yeah, I've always told people too that during those slower times, if you get a really big trade to come out of that low volatility, you're probably going to miss it. And you're just going to have to mentally deal with that, because there really is no way to catch something that comes out of nowhere from a dead period that quickly. So this might not have been something we ever talked about on the podcast, but I've said it on my channel before. So many interesting things too. And I'll say too, as far as January goes, I've actually had very good Januaries. I actually know that's one of my best months year after year, typically. And maybe that makes a lot of sense, because maybe not so much in stocks, but if people are getting killed in stocks, maybe they just take their money out.